Welcome to our comprehensive guide on understanding credit scores. In this video, we'll delve into the intricacies of credit scores, demystifying how they work and providing practical tips on how to improve yours. Whether you're new to credit or looking to boost your score, this guide will equip you with the knowledge you need to navigate the world of credit with confidence. Number 1. What is a credit score? A credit score is a three-digit number, ranging from 300 to 850, that reflects your creditworthiness. It's essentially a numerical summary of your credit report, indicating to lenders how likely you are to repay borrowed funds. Credit scores are crucial when applying for loans, credit cards, mortgages, and other financial products. Understanding how they're calculated and what they represent is key to managing your financial health effectively. Your credit score is calculated based on several factors, including your payment history, credit utilization, length of credit history, types of credit accounts, and new credit inquiries. Payment history, which accounts for about 35% of your score, reflects whether you paid your bills on time in full. A consistent history of on-time payments can positively impact your score, while late payments, defaults, or bankruptcies can lower it. Credit utilization, which makes up about 30% of your score, refers to the amount of credit you're using compared to your total available credit. Keeping your credit utilization ratio low, ideally below 30%, demonstrates responsible credit management and can boost your score. The length of your credit history contributes roughly 15% to your score. Lenders like to see a longer credit history as it provides more data on your credit behavior and repayment patterns. Opening new accounts can lower the average age of your accounts, potentially impacting your score. The types of credit accounts you have make up about 10% of your score. Lenders prefer to see a mix of credit types, including revolving credit, egg credit cards and installment loans, egg mortgages, auto loans. Number 2. Factors that influence your credit score. Your credit score is influenced by various factors, including payment history. Timely payment of bills and debts is the most significant factor affecting your credit score. Late payments can have a significant negative impact. Credit utilization ratio. This ratio measures the amount of credit you're using compared to your total available credit. Keeping this ratio low, ideally below 30%, can positively impact your score. Length of credit history. The length of time you've been using credit accounts for a portion of your credit score. A longer credit history is generally seen as more favorable. Types of credit. Having a mix of credit types, such as credit cards, loans, and mortgages, can positively impact your score. New credit inquiries. Opening multiple new credit accounts within a short period can temporarily lower your score, as it may indicate financial distress or a higher risk of default. Number 3. Understanding credit score ranges. Credit scores are typically categorized into ranges, each indicating a different level of creditworthiness. 4. 300,000, 579. Individuals in this range may struggle to qualify for credit or may only be eligible for high-interest loans. There, 580,669. While individuals in this range may qualify for credit, they may face higher interest rates and less favorable terms. Good, 670,739. This range represents a solid credit history and increases the likelihood of being approved for loans at favorable rates. Very good, 740,799. Individuals with scores in this range typically receive better loan terms and lower interest rates. Excellent, 800,850. The highest credit score range, indicating exceptional creditworthiness and access to the most favorable loan terms. Number 4. How to check your credit score. It's essential to regularly monitor your credit score to stay informed about your financial health and detect any errors or fraudulent activity. You can check your credit score through various means, including credit bureaus. Equifax, Experian, and TransUnion are the 3 major credit bureaus that provide credit reports and scores. You're entitled to one free credit report from each bureau annually. Financial institutions. Many banks and credit card issuers offer free access to credit scores for their customers through online banking platforms or mobile apps. Third-party websites. Several online platforms provide free access to credit scores and credit monitoring services. Be cautious when using third-party sites and ensure they're reputable and secure. Number 5. Tips for improving your credit score. Improving your credit score requires diligence and discipline, but it's entirely achievable with the right strategies. Here are some tips to help you improve your credit score. Pay bills on time. Timely payment of bills is crucial for maintaining a good credit score. Set up automatic payments or reminders to ensure you never miss a due date. Reduce credit card balances. Aim to keep your credit card balances low relative to your credit limits. High credit utilization can negatively impact your score. Limit new credit inquiries. Minimize the number of new credit applications to avoid potential negative effects on your credit score. Only apply for credit when necessary and be selective about the types of credit you pursue. Monitor your credit report. Regularly review your credit report for errors, inaccuracies, or signs of identity theft. Dispute any discrepancies promptly to ensure they're corrected. Diversify your credit mix. Having a mix of credit types, such as credit cards, installment loans, and mortgages, can positively impact your credit score. However, only pursue credit that you genuinely need and can manage responsibly. Number 6. The impact of credit score on financial opportunities. Your credit score plays a crucial role in determining the financial opportunities available to you. Lenders, landlords, and even potential employers may use your credit score to assess your creditworthiness and reliability. A higher credit score can open doors to better loan terms, lower interest rates, higher credit limits, and even lower insurance premiums. Understanding how your credit score influences these opportunities can motivate you to prioritize improving and maintaining a healthy credit profile. Number 7. Strategies for rebuilding credit. If you've experienced financial setbacks or have a less than perfect credit history, don't despair. There are several strategies you can employ to rebuild your credit over time. Start by addressing any negative items on your credit report, such as late payments or collection accounts. Develop a plan to pay off outstanding debts. Prioritize bills to avoid further delinquencies, and consider negotiating with creditors for more favorable repayment terms. Additionally, opening a secured credit card or becoming an authorized user on someone else's account can help establish positive payment history and improve your credit score gradually. Number 8. The role of credit utilization in your score. Credit utilization, or the ratio of your credit card balances to your credit limits, is a significant factor in your credit score calculation. Maintaining a low credit utilization ratio daily below 30% can positively impact your score and demonstrate responsible credit management. Strategies for managing credit utilization include paying off balances in full each month, spreading purchases across multiple cards to distribute utilization evenly, and requesting credit limit increases to lower your utilization ratio. By keeping your credit utilization in check, you can improve your credit score and demonstrate financial responsibility to lenders. Number 9. Understanding credit inquiries and their impact. When you apply for new credit, lenders typically pull your credit report to assess your creditworthiness. These inquiries, known as hard inquiries, can temporarily lower your credit score. However, not all inquiries have the same effect. For example, multiple inquiries to the same type of credit within a short period, such as mortgage or auto loan inquiries, may be treated as a single inquiry to minimize the impact on your score. Understanding the types of inquiries and how they affect your credit score can help you make informed decisions when seeking new credit. Number 10. Long-term strategies for maintaining good credit. Maintaining a good credit score requires long-term commitment and responsible financial habits. Beyond the immediate steps to improve your credit, it's essential to develop strategies for maintaining your progress over time. Regularly monitor your credit report for errors or signs of fraud. Review your credit score periodically to track your progress, and adjust your financial habits as needed to stay on track. By cultivating healthy financial habits, making timely payments, and avoiding excessive debt, you can establish a solid credit foundation and enjoy the benefits of good credit for years to come. Number 11. The importance of diversifying your credit mix. Having a diverse mix of credit accounts can positively impact your credit score. Lenders like to see that you can responsibly manage different types of credit, such as credit cards, installment loans, and mortgages. By diversifying your credit mix, you demonstrate your ability to handle various financial obligations, which can strengthen your creditworthiness over time. However, it's essential to only apply for credit when necessary and to manage your accounts responsibly to avoid overextending yourself financially. Number 12. The role of length of credit history in your score. The length of your credit history also plays a significant role in determining your credit score. Lenders prefer to see a longer credit history as it provides more data on your credit behavior and repayment patterns. This means that closing old accounts or opening new ones can impact the average age of your accounts, potentially affecting your credit score. While you can't change the length of your credit history overnight, maintaining long-standing accounts in good standing and avoiding unnecessary changes can help you build a solid credit foundation over time. Number 13. The impact of negative information on your score. Negative information, such as late payments, defaults, bankruptcies, or foreclosures, can significantly impact your credit score and stay on your credit report for several years. These derogatory marks can lower your score and signal to lenders that you may be a higher-risk borrower. While it's challenging to remove negative information from your credit report, you can mitigate its impact over time by focusing on positive credit behaviors, such as making on-time payments, reducing debt, and avoiding new credit issues. Number 14. The benefits of regularly monitoring your credit. Regularly monitoring your credit report is essential for understanding your credit health and detecting any errors or signs of identity theft early. By checking your credit report regularly, you can identify inaccuracies or fraudulent activity and take steps to address them promptly. Many credit monitoring services offer free access to your credit report and score, making it easier than ever to stay informed about your credit status. By staying vigilant and proactive, you can protect your credit and financial well-being in the long run. Number 15. Leveraging credit-building tools and resources. Several tools and resources are available to help you build and maintain good credit. From credit monitoring services and financial apps to credit counseling and educational resources, there are many ways to access the information and support you need to improve your credit score. Take advantage of these resources to learn more about credit management best practices, track your progress, and access personalized recommendations for improving your credit health. By leveraging these tools and resources, you can take control of your credit journey and achieve your financial goals. Understanding credit scores is essential for managing your financial well-being and accessing credit on favorable terms. By knowing how credit scores work and implementing strategies to improve yours, you can take control of your financial future and achieve your goals. Remember to monitor your credit regularly, stay informed about changes to your credit report, and take proactive steps to maintain a healthy credit score. With diligence and perseverance, you can build a solid credit history and enjoy the benefits of financial stability and flexibility. Don't forget to like, share, and subscribe for more valuable insights on personal finance and wealth management.